I think we've got a real uncertainty problem. I think it's going to be hard to fix that. And we're looking at a slowdown relative to what was forecast almost for sure, and a serious near 50% prospect of recession.
Hello, everyone, and welcome to the Week Ahead on Nomura Podcasts. It's Friday, the 14th of March. My name is Ruben Paracuelis, Chief Southeast Asia Economist at Nomura, based in Singapore. Market participants continue to grapple with very high degree of uncertainty, which is starting to have real economic consequences, as Larry Summers, former U.S. Treasury Secretary, argued there. The week ahead should be very interesting, given key central bank decisions on deck, and we could get some guidance on how policymakers think about and deal with the uncertainty, particularly from rising global trade tensions. I'm fortunate to be joined by a few of my colleagues in this episode. David Seif, our Chief Economist for Developed Markets, lays out his expectations for an on-hold decision at the upcoming FOMC meeting and for the Fed's tone to continue to emphasize patience. George Buckley, our Chief Economist for Euro area in the UK, also expects a pause from the BOE's cutting cycle with similar forward guidance. And Yuichiro Nozaki from our Japan economics team in Tokyo explained why communication is a bigger focus this time from the Bank of Japan's meeting, where a skip in the hiking cycle is widely expected. So let's dive in. Okay, let's start with the US. Hi, David. Welcome back to the podcast.
Hey, how are you? You've been great to be back.
Good. The big event next week, of course, is the FOMC. What's your forecast and what's the likely tone from the Fed?
Yeah, so certainly we don't expect there to be any cut next week. I think that's well priced in on the market, and that's certainly no surprise. But the tone that I think Powell and the Fed in general want to set is one of patience, one of not being anywhere close to cutting rates in response to recent market volatility. I think that's really pretty consistent with Powell's speech last week and in the relatively few, but nonetheless public comments that he has made over the past couple of months. There's really no panic from the Fed right now, and as much as the equity markets have sold off, I think the Fed is really stressing patience. That's a word that Powell has used multiple times, and I think that's the tone they want to set next week.
Okay, that's clear. And one thing that I'm curious about, David, and I'm asking all the other speakers in this podcast, because this is turning out to be a central bank focused episode. How does the Fed, in your view, think about the uncertainty from Trump's policies? Do FOMC members continue to maybe err on the side of caution because there could be some inflationary impact of the tariffs? Or are they now also paying attention to markets focusing on increased recession risks?
Well, I'm sure they're paying attention to both. And our longstanding call has been A, that there would be tariffs of significant size, and B, that the inflationary impact would dominate the growth impact. And I think that really remains to be seen. But certainly markets have behaved as though they expect the opposite in recent weeks. It hasn't caused us to change our call, however. So we still think that that tariffs, which both push growth down and push prices up, we think that the Fed is going to be more focused on the potential for prices to rise, and it's going to lead the Fed to actually not cut at all this year. I would say that at this point, I think any reasonable policymaker, and I certainly include the Fed in this, would have to say that the jury is still out on this. So on the one hand, I don't think they want to signal anything super hawkish at this point, because there is certainly the risk, probably the rising risk, that the growth risks are, or the growth impact is going to be bigger than expected. But on the other side of the coin, they also want to be very certain that they're not cutting into the face of inflation, a pickup of inflation. And so that's why I think they're continuing to stress stresses patience. And I think the key thing here is that tariffs really are a supply shock. So if you have a negative demand shock in an economy, it's very clear that a central bank should be dovish. It pushes growth down, it pushes prices down. Both of those cause a central bank to be more dovish. When you have a negative supply shock, however, a central bank with a dual mandate like the Fed is pulled in opposite directions, and it has to decide which one is the more important one. I would say that part of what goes into our view, that the Fed is going to focus more on the inflation side than on the growth side, comes from the fact that the Fed is already basically on target when it comes to its full employment mandate. So it doesn't want to see a deterioration in markets, in the labor market, but it is already where it feels it sort of needs to be on that. But it's also, on the contrary, above target on inflation. So if the two move, growth and inflation, in opposite directions in roughly equal amounts, because the Fed is already off target on inflation, we really think that the Fed was going to have to prioritize the inflation aspect so it doesn't move too far away from where it should be on that specific mandate.
Yeah, that's really super interesting, and yeah, makes a lot of sense to me. On the dot plots, David, do you expect any changes, and how do you think these could impact markets given 3 cuts are already now priced in this year?
Yeah, so first of all, I'll just say that as of this recording, we have not published our FOMC preview. But let me talk a little bit about sort of the general scope of things, which I assume will still be hopefully informative to all our listeners. First of all, the general way in which we think the Fed is approaching this is that it is a choice between 1 cut and 2 cuts. So we certainly do not expect any increase in the number of cuts in the dot plot. And we think it's going to be a close call between sticking with 2 or reducing the number of cuts to only 1. So certainly different from the change in market pricing that has occurred in the past few weeks. And I really would go back to the Fed stressing patience, as in it does not want to signal that there is a Fed put of any kind, or at least if there is one, it wants to signal that put is still well out of the money and is nowhere close to being exercisable at this point. So I think that really, whether the dot plot shows 1 or 2 cuts, Powell will stress that that second cut is a very close call, which would be a marginally more hawkish message than 3 months ago with the December dot plot.
Okay, got it. And finally, David, in your team's recent piece on the Trump put, do you think a further setback in markets or the real economy cause Trump to back down and de-escalate trade conflicts?
Yeah, so I just talked about a Fed put being well out of the money. I would say that to the extent there is or is not a Trump put, that is also probably pretty far out of the money as well. Focusing on that piece, which was spearheaded by Jeremy Schwartz and Ruchir Sharma, who often appear on this podcast as well. I think the key takeaway from that is that if we think about when Trump in his first term really started to escalate the trade war, primarily with China in that case, it was in 2018. And in 2018, it was actually one of the worst years for equity markets when there was not a recession. And that did not seem to dissuade him from moving there. So as much as Trump certainly has historically touted the stock market's performance when it's good, I think it would be a mistake for listeners to assume that means that he is explicitly targeting the stock market and will step back from this. I'd also say that when it comes to tariffs this term, as opposed to in Trump's first term, tariffs are a significantly more central aspect of Trump's economic platform. And so, the reason behind that is that I think that Trump really is counting on revenues from the tariffs to try to fund a renewal of his tax cuts, and B, what I think he hopes will be at least additional tax cuts as well. So taking a step back from the tariffs would actually have a bigger impact in setting back his broader economic platform. And it just makes it that much more unlikely that he will take a significant step back. To be clear, our view is that on April 2nd, when Trump's reciprocal tariff announcement is made, tariffs will be going up, not going down from where they are right now.
Yeah, excellent. Sounds like we're going to have to expect more then. Yeah, thanks so much, David.
My pleasure.
Is that in an environment of uncertainty, a strong commitment to maintaining price stability over the medium term is more important than ever. This commitment will require agility to respond to new shocks, but within a well-defined framework that limits short-sighted reactions and unbridled discretion.
Now, swinging over to London, where George is joining me from. Hey, George, thanks again for being in the podcast.
Hi, Ewan. It's a pleasure.
Yeah, let's start with the BOE, Bank of England. What do you expect on the policy rate decision? And I'm particularly curious to hear if you expect any changes to the forward guidance in this period of high uncertainty.
I think with a lot of central banks at the moment, guidance is getting tricky because it's not obvious that central banks can give a clear indication of where they're going from here. We've seen that, for example, in the ECB. It's a meeting by meeting approach. That's what the Bank of England said last time. I think that will probably be the same is true this time. That said, I think we are all under the impression, reasonably so, that the bank will continue to cut interest rates. Not at this meeting, but certainly at monetary policy report meetings. And I think there's more than just one in there. I think we've probably got 4 more cuts to come. We only think there's 1 more cut to come from the ECB, but I think the Bank of England, even though they're not going to tell us this, we probably see them cutting rates down to about 3.5. They're currently 4.5, so that does mean we've got another 100 basis points in the pipeline. But as I say, nothing at this report or this meeting, and I suspect we did think it could be quite close, but the Deputy Governor, Dave Ramsden, has suggested that maybe he won't be voting for a cut this time. So maybe a 6-3 decision, 6 in favour of no change, 3 in favour of a cut.
Okay, that's interesting. So Bank of England will also be taking a little bit of a breather next week. Now, speaking of the ECB, I'm wondering if you see a similar risk for the Bank of England as the ECB, where you've recently scaled back your rate cut forecast this year because of what's happening with the fiscal situation. Is there some similarity?
I think the big difference between the two central banks is one of them's cutting a lot more, one of them isn't, in our view. We're actually looking for the ECB to do less than the markets. We're looking for the Bank of England to do more. I'm not necessarily you should see that as us being more dovish on the Bank of England. Certainly it's more dovish in terms of rate changes, but where we get to at the end of the forecast horizon, the start of next year, is we think the BOE is going to end up at 350, which is probably on the upper end of neutral. If the ECB ends up at 225, which it would do if they cut by another quarter point, which we expect, then that probably would be in the middle of neutral in our view. So I'm not even sure that you can look at these two central banks and say that one is, or the Bank of England is more dovish than the ECB. It really does relate to where you think neutral is and where you think the end point is. And for the Bank of England, we think it's probably at the upper end of neutral.
Okay, got it. That's clear. And I guess on the topic of tariffs, we've had these latest U.S. tariffs on metals and Europe's retaliation. So what do you make of these? I know you put it on your report as only an opening gambit, which I quite like. What do you expect to be next?
So I think that's a very good point. It is an opening gambit. I think the fact that Europe has retaliated has put Europe firmly in Trump's firing line for subsequent tariffs. This is very small, what they've done so far. We're talking about tariffs on about 26 billion worth of exports or from the US to Europe and vice versa. The cost that the European Commission thinks this will be in terms of extra tariffs on these goods is about 6 billion euros. Now, if you look at that relative to total US goods imports, it's about 1.7%, so that's pretty sizable. But when you look at it relative to total extra EU goods imports globally into the EU, it's much, much smaller. It's about 0.25%. And then when you look at 6 billion relative to total GDP, which is, of course, also an interesting metric, it's tiny. So it is an opening gambit. It's a very small effect, maybe not on those industries or product lines specifically, but I think it is a small effect on Europe in an aggregate sense. I think what's more interesting is what comes next when it's maybe 25% tariffs against autos or other things, as Mr. Trump talked about. So that's the key thing. And just staying with the whole Europe debate on tariffs, it's interesting to see that at the time we're speaking now, Keir Starmer, the Prime Minister of the UK, has decided not to retaliate as yet. And maybe that's a very calculated risk to think, well, maybe that will appease Mr. Trump. Possibly the fact that the UK is running a trade deficit with the US, not the other way around, could appease him, and maybe the UK gets away with it. It's not our view at the moment. We think that on average, all our forecasts are based on 10% tariffs across Europe from the US onto Europe and vice versa. That might not be the case for the UK. It might even be larger for Europe, but we'll have to wait and see.
Great. Okay. So it sounds like more to come and then very different approaches in Europe. Yeah, we'll leave it there. Thanks, George.
Thank you, Evan.
Okay, we now go to Japan, and I'm very glad that Uichiro-san from our Japan economics team in Tokyo can join me today. Hi, Uichiro-san. Thanks for coming to the podcast.
Hi, thank you for having me.
Yeah, first question. For the BOJ's monetary policy meeting on the 18th and 19th of March, we expect the policy rate to be left unchanged. What's the thinking behind that?
The main reason is that BOJ just raised its policy rate at the January meeting. The bank says that it will continue rate hikes if the economy and inflation is on track with their outlook. Just 2 months from last meeting is not enough for BOJ to judge the impact from its policy rate hike and whether the economy is consistent with their outlook. According to the Bloomberg survey conducted for about 50 economists, no respondents expect rate hikes in the March meeting. So the skip of rate hike this month is a market consensus.
Yeah. And what will you be focusing on in terms of the communication from the BOJ? I suppose wage hikes and the results of the spring wage negotiations will be most important?
Yeah. The assessment on the wage hike is one important factor. Judging from the current information, wage hikes agreed in the spring wage negotiations will be similar or a bit stronger than last year. Governor Ueda used the word solid to describe the expectation for wage hikes this year, and the result will be consistent with this view. But spring wage negotiations do not have much information about wage hikes by SMEs. We expect Governor Ueda will show willingness to confirm the spread of wage increases at April branch managers meeting. In addition, I pay attention on how BOJ will evaluate the effect of current food inflation and its implications for monetary policy. BOJ cannot directly handle with food inflation caused by supply-side issues, but the food inflation cannot be negligible for 2 reasons. Firstly, private consumption is sluggish, especially in Q1 this year. Food inflation deteriorates real income and consumer sentiment. Secondly, food inflation may boost households' inflation expectations for medium to long term. If so, one-off cost push may lead to a sustainable inflation.
Okay, and I'm curious, do you think the BOJ will also provide an assessment of how the uncertainty in the external backdrop could also have some implication on its own monetary policy?
Uncertainty over U.S. economic policy is higher than it was at the January meeting, as U.S. President Donald Trump announced the introduction of tariffs on a wide range of countries and regions. I do not expect Governor Ueda to deliver a clear message on the overseas economy, which suggests some monetary policy direction. Deputy Governor Uchida held a press conference last week and received a question about the same issue. He just said that it is not possible to clearly assess the impact of tariffs, and we have no choice but to keep a close eye on them. Basically, we think Governor Ueda will follow the direction of Deputy Governor Uchida's remark and just say he will keep an eye on U.S. policy.
Okay, got it. That's interesting. And finally, could you just remind us when do you expect the BOJ to hike next, and by how much in total in this cycle?
We expect that interest rate will be raised in July 2025 and January 2026, and BOJ will pause at 1%. While wage and price increases will support the bank's continued interest rate hike, there is still a sense of stagnation in the economy due to the uncertainty surrounding the U.S. economy. Therefore, it is unlikely that BOJ will raise interest rate hike in a hurry. Raising the policy rate above 1% is more like neutralization of monetary policy than adjusting of monetary easing. As we predict the year-on-year increase of core CPI will fall below 2% in 2026, we do not think that such price situation will justify the neutralization of monetary policy.
Okay, great. Let's leave it there. Thanks very much, Shuichiro-san.
Thank you very much.
For the rest of Asia, we have a couple of central bank decisions in the week ahead. In Indonesia, we expect BI on Wednesday to keep the policy rate unchanged at 5.75%, given BI is still focused on its FX stability mandate, and the IDR has seen renewed underperformance of late. BI will continue, however, to use other instruments in its toolkit, such as macroprudential measures, to help sustain growth. In Taiwan, we also expect the CBC on Thursday to be on hold at 2%, but with a hawkish tone, maintaining a still positive growth outlook despite high external uncertainty, and revising up slightly its inflation forecast due to strong domestic demand and potential electricity tariff hikes in April. Finally, in China, we also have activity data for January and February on retail sales and fixed asset investment, which we expect to both improve from December, as well as IP growth to remain broadly steady at 6.1%. That's it for now, and thank you again for joining us at Nomura Research on the Week Ahead, edited and produced by John Dalton. If you enjoy the content, please like and subscribe to Nomura's podcasts on Apple, Spotify, and SoundCloud, or your usual provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can also check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.